Hi friends, welcome to EduTap. So today we are going to discuss some of the important MCQs on this very important topic, which is accounting for share capital. Now balance sheet of every company, it comprises of the figure of the equity share capital or simply share capital. Now this figure might amaze you. You might be thinking how this figure has been arrived at. So we are going to understand what is this share capital and how this figure of share capital is arrived at in the balance sheet. We are going to understand the accounting nuances pertaining to share capital. So let's start our today's discussion. So let's start with the first question. Dash is that portion of the called up capital which has been actually received from the shareholders. Authorized capital, paid up capital, subscribed capital, nominal capital or registered capital. Now the balance sheet of the company on the equity and the liability side, it is prepared in the form of a statement, but I'm preparing it in a T form. So just ignore the format as of now. On the equity and the liabilities front, it is going to have this equity share capital. Now equity shareholders, they are the owners of the company. Now owners of the company, they have put in certain money in the company. Now the company is a separate entity and the people who own it, they are separate. Now the people, they are investing money in the company in the form of shares and they are referred to as the shareholders. The company is going to regularly demand money or regularly call money from the shareholders and the shareholders are going to pay this particular money. Now the question says, if the company has called some money from the shareholders, but not all the shareholders have paid this money, the money received is less. Now this money received, what is going to be the technical term for it? This is what we are asked here. Is it going to be authorized, paid up, subscribed, nominal or registered capital? So friends, now let's try to discuss the different concepts related to the share capital of a company. Now, whenever a company, it is registered, it is incorporated, different documents are required to be prepared. One of the very important document is Memorandum of Association, MOA. Now, this particular document has one capital clause. So this capital clause, it mentions how much capital can be issued by the company. So suppose we incorporate any company and the authorized capital which we have set for the company, let's assume for our company it is 2 lakh shares of rupees 10 each. So this is the maximum shares which the company can issue during its lifetime. Of course, this amount can be later amended by the company as well. So this is the authorized capital. It is the nominal capital. It is the capital with which the company has been registered with. Now, the company may not feel the need to issue entire 2 lakh shares at the very beginning. The company may say, okay, right now I would only issue 1 lakh shares to the public. So right now I'm only issuing the 1 lakh shares. So 1 lakh shares, this is going to be the issued capital. So that part of the authorized capital which is actually issued by the company to the public, it is going to be the issued capital, and the remaining 1 lakh, this is going to be unissued capital. 1 lakh shares, they are unissued. So the company has decided I'm going to issue 1 lakh shares to the public. So it comes up with a public issue, it comes up with an IPO, and there are huge advertisements of the company in papers and people are invited to apply for the shares of the company. But ultimately what happens is, not all the investors, they are interested to invest in the company. Ultimately what happened, only 95,000 shares of the company, they were subscribed by the public, they were taken up by the public. Not all the 1 lakh shares, they were taken up by the public. So this 5,000 shares, this is going to be unsubscribed capital, and 95,000 shares, this is going to be the subscribed capital of the company. So now what would happen? The company would want that shareholders should pay up the money on these 95,000 shares. So shareholders, they have to pay 95,000 into 10 rupees to the company. Now the company may say, I'm not calling the entire amount as of now. This 10 rupees has to be paid by you to me. But okay, right now I am just telling you to pay me rupees 5. So the company is not calling the entire amount on the 95,000 shares. On the 95,000 shares, it is only calling rupees 5 as of now. So this rupee 5 into 95,000, this is going to be the called up capital of the company. Now the shareholders, the shareholders of 95,000 shares, they have to pay rupees 5 to the company. Now some shareholders, they are very lazy and they do not want to pay rupees 5 as of now. They are just delaying it. So the company may only get 90,000 shares into rupees 5. So company may not get these rupees 5 on every share. So 5,000 shares, for 5,000 shares the company suppose does not get this particular rupees 5. The company is only getting it for 90,000. So this 90,000 into 5 is going to be the paid up capital. So this is the amount which is actually paid up by the shareholders. Now this 5,000 into 5 which is pending, this is going to be the arrear amount. This is still in arrear and the shareholders would be required to pay this amount to the company, and if they do not pay to the company may try to forfeit their shares. The company may cancel their shares and the company may forfeit the amount they have already paid to the company, if any. So in this particular case, we have understood how this entire hierarchy of share capital of the company works. So not all the authorized capital shares are going to be issued to the public. Not all the issued capital is going to be subscribed by the public. Not all the amount is going to be called up by the company at the time of subscription, and not all the shareholders, they are going to pay the full amount that the company is calling up from them. So that's why we have different amounts of issued capital, subscribed capital, called up capital, and paid up capital. So for you guys, I've also briefly mentioned the explanation of all these sorts of capital which you would find in the company's financial statements. So on the top, we have the authorized capital. Authorized capital is on the top. This is the nominal capital. This is the capital which the company is registered with. It is mentioned in the memorandum of association. Then comes the issued capital. It is that part of the authorized capital which is actually issued to the public. Now there is the subscribed capital. Of the issued capital, how much has been actually taken up by the public, actually subscribed by the public. Called up capital, the money which the company is calling from the shareholders. So for the 95,000 shares that were taken up by the public, the company called rupees 5. So this was called up capital, and now the shareholders, they have only paid this amount for 90,000 shares. So your paid up capital is going to be less. The portion of the called up capital that has been actually received from the shareholders, it is paid up capital. If any amount is still pending to be received, it is called as the call in arrear. It is the amount which is pending to be received from the shareholder. So now we can easily answer this question that paid up capital is the portion of the called up capital which has been actually received from the shareholder. So answer is going to be option number B. Moving on to the next question. When the company allots the shares to shareholders, which account would be credited by the company? Share capital account, bank account, shareholder account, share forfeiture account, or none of the above. So what the company is doing, suppose a company, it comes up with the issue of 1 lakh shares of rupees 10 each. The entire amount is called up at the time of application only. So the shareholders, they have to furnish 10 lakh rupees to the company. Now this amount is to be ultimately transferred, ultimately credited to which account? This is what we are being asked here. Share capital, bank, shareholder, share forfeiture, or none of the above. So friends, these are the journal entries which are passed at the time when the company issues its shares. So I told you that the company is coming up with the issue of 1 lakh shares of rupees 10 each, and all the investors who are interested, they have subscribed entirely for these 1 lakh shares and they have submitted rupees 10 to the company. So in the bank account of the company, 10 lakh rupees they are going to come. So bank account is going to be debited. Increase in asset is going to be debited. So always remember the rules of debit and credit. Increase in asset is going to be debited. So here the bank account is going to be debited, and the account which we are going to credit here is to share application account. We have received this 10 lakh rupees and we are going to transfer it to another account which is share application account. Now what is going to happen here? This share application which we have received, this is ultimately going to be transferred to the share capital account. So the company is going to scrutinize all the applications and ultimately the company is going to allot the shares to the shareholders. So this share application account is ultimately going to be transferred to another account which is share capital account. So this 10 lakh rupees is going to be transferred to the share capital account. So this is how the things they work in practice. So this is how the things are done. You would have made a single entry only. You would have said, okay, bank account debit to share capital 10 lakh. This would have been a very simple entry that could have been made for this 10 lakh rupees. But practically how the things work? Practically, the application amount is received at a certain point of time and the shares are allotted after a certain days. So now we have to make two journal entries for it. So that's why we have two separate journal entries of it. The crux of these two journal entries is this only, that we have received 10 lakh in bank and we have received 10 lakh as share capital. Now share capital, it is capital, increase in capital is going to be credited. So that's why we have credited the share capital account. The share capital account is going to be reflected in the balance sheet of the company under the equity and liability side. So now we can easily answer this particular question, that when the company allots the shares to the shareholders, which account would be credited by the company? The company is going to credit the share capital account. So answer is going to be option number A. Next question. A company invites applications for 10,000 shares and received applications for 15,000 shares. So this is what practically happens. Zomato comes out with an issue of shares. A number of times the issue is oversubscribed. So the company here, it comes out with an application for 10,000 shares and it received application for 15,000 shares. Now the directors of the company, they have to decide how the things are going to work here. Now the directors, they decided to reject the applications for 2,500 shares outright. So out of the 15,000 applications which were received, 2,500 they were rejected then and there only. So out of the remaining 1,200, what we did, we made a pro rata allotment of 10,000 shares. So these 12,000 shares, they were allotted 10,000 shares. Now in this case, which of these statements they are true? That is what we have to identify. Shares would be allotted in the ratio of 4:5 to all the accepted applications. Money on applications for 2,500 shares rejected would be refunded fully. For all the accepted applications, excess amount on the application would be adjusted against the allotment amount. Only B and C would be true. All the above would hold true. So we have to answer this particular question. I believe you are able to understand this question. Okay, the company came up with this particular issue for 10,000 shares, 15,000 applications received, 2,500 rejected, and for the 12,500 we made a pro rata allotment. We made a proportional allotment. We can say like that, a proportional allotment was made. Okay, 12,500 shares were allotted 10,000 shares only. So anyone who was holding, say anyone who had applied for say 125 shares, he only got 100 shares of a company. So this is the meaning of the proportional allotment. So now in this particular case, let's try to understand how the things they are going to work. So 15,000 shares, applications were received for 15,000 shares. So money would be received for the 15,000 shares. We would receive the money, bank account is going to be debited and share application account is going to be credited, as we saw in the previous question. Okay, now what we have to do, for the 15,000 shares, 2,500 is outrightly rejected. So for these 2,500, we have to refund this money. So the next entry that we pass is share application account debit to share capital. So share application account is going to be debited for 15,000 shares, but share capital is ultimately going to be only credited for 10,000 shares. Now this difference is to be adjusted in two separate sorts of accounts. Now for these 2,500 shares, entire refund is being issued. So we are going to issue money from our bank account is going to reduce, our asset is going to be reduced, and we are going to credit it. So bank account is going to be credited by 2,500 shares, by the amount of the 2,500 shares. So I'm only talking in terms of shares, but you would actually be transacting in the amount, say 2,500 into 10, 50 or 100, this would be the amount. Now for the 12,500 shares, we only allotted 10,000 shares. For the shareholder who had applied for 5 shares, we only allotted him 4 shares. So this is the ratio in which the shares were allotted by the company. Now what the company does, it does not refund the excess money. The company says, okay, I have received this excess money from you, but I did not call the entire amount of the shares at the time of application. The company, what it did, the company called up, say the share was worth rupees 10. Okay, and the company only called up rupees 5 at the time of application, and the balance rupees 5, it was to be called on at a later stage. Okay, so now what the company does, the company, it takes this excess amount of money, it keeps it with itself only, and when at the later stage, when this money is due, the company adjusts it from the amount which is to be received from the shareholders. So next time when the company calls for another ₹5 on the shares, the shareholders, they are not going to pay the entire ₹5. They've already paid excess amount at the time of application, and this is going to be adjusted. So when the company makes the next call, this next call is referred to as the allotment. First entry is for the share application and the second entry is for the allotment. So we say at the time of allotment, the company made another call of ₹5. So now this ₹5 is going to be adjusted at the time of allotment. So we now only transfer this 2500 shares worth of money to the share allotment account. So this is how the things are going to practically work here. We received the money for 15,000 shares, but we were not allotting 15,000 shares. We were only allotting 10,000 shares. And at the time of allotment, we had to call the balance amount. But now what we are doing, we are making some adjustments here. For the 2500 shares, entire amount is going to be refunded by bank, and for the 2500 extra shares which were not allotted, the allotment was proportional. So this amount is going to be transferred to the next stage to the time of the allotment. So this is how the things are going to work here. So now we can easily answer this particular question. That the company is going to allot the shares in the ratio of 4:5 to all the accepted applicants. For the 12,500, we are going to only allot 10,000. So this ratio, it comes out to 4:5. Money on application for 2,500 would be refunded. We saw the credit to the bank account that has been made in the general entry. And for all the accepted applications, the excess amount which was received on application is going to be adjusted against the allotment amount. So this is also going to be true as we saw in the journal entry. So A, B and C, they all are true. So answer is going to be option number E. So now let's move on to the next question. When the company issues shares at a premium on face value, the excess of issue price over face value of the share would. Now what practically happens is, the share of the company is worth ₹10. And the company actually issues it at ₹100 or maybe even more than that. Now this extra amount which the company is receiving, that is ₹90. What is the treatment of this particular amount? This is what is being asked here. It is said that it is credited to a separate account, security premium account. It is debited to this account, and how it is shown in the balance sheet, this is also being asked here. Reserve and surplus or non-current asset. Or it is also being asked whether it is shown as other income in the statement of profit and loss. So this is what this question is asking to us. So friends, when the company, it issues shares at a premium, so here it is mentioned, suppose the nominal value, the face value of the share is ₹100, and the company, it is actually issuing it at ₹105. So in this particular case, ₹5 is going to be your premium. 5% is going to be the premium. Now this premium amount is generally called with the amount due on the allotment. So at the time of allotment, we call for this premium amount, and this premium amount is credited to a separate account called securities premium account and is shown under the title equity and liabilities of the company's balance sheet under the head reserves and surplus. So this is how the accounting treatment is going to be like. So the company, it is receiving 105. Now the ₹100, it is going to be transferred to the share capital account, and this ₹5 is going to be transferred to the securities premium account. And this securities premium account is going to be shown as a reserve and surplus, in the balance sheet of the company on the equity and the liability side. So this is something which you have to remember from the examination perspective. Reserve and surplus on the balance sheet of the company. So this is the treatment of the securities premium. So guys, now we can easily answer this question, that when the company issues shares at a premium on face value, the excess of issue price over face value is going to be credited to a separate account called securities premium account, and this amount is going to be shown under the head reserves and surplus in the balance sheet. So clearly answer is going to be option number A here. So now let's take a look at another question. It says Sahil, a shareholder, failed to pay the money for second and final call of ₹20 on 1,000 shares issued to him at par, face value of ₹100 per share. Now his shares were forfeited. Share forfeiture account would be credited by how much amount? Now sometimes what happens is, the company, it calls the money in installments. So suppose the share is worth ₹100. The company would say, okay, you pay me ₹30 at the time of application and you pay me say rupees 30 at the time of allotment. After your application is accepted, at the time of allotment I am going to make a call of rupees 30 and you pay me another rupees 20 at the time of first call and you pay me the balance rupees 20 at the time of second and final call. So at the time of application this is to be paid. When the allotment is made you have to pay again rupees 30 and the remaining amount is to be called in first and second call. So there was a shareholder named Sahil. He paid this rupees 30 at the time of application. At the time of allotment rupees 30 was paid and at the time of first call rupees 20 was again paid. But when the company made a call for rupees 20, now this rupees 20 it was not paid by Sahil. Now the company is very angry with Sahil. And now the company has decided, the company gave him ample opportunity to pay this amount, but the Sahil is not paying this amount. So the company has decided that it is going to cancel his shares. It is going to forfeit his shares. उसके जो शेयर है वो कंपनी क्या कर लेगी, जब्त कर लेगी और उसका पैसा जो कंपनी को मिला होगा वो कंपनी के लिए एक प्रॉफिट की तरह यहाँ पे हो जाएगा. इट इज नॉट अ नॉर्मल प्रॉफिट बट इट इज गोइंग टू बी सॉर्ट ऑफ अ अननॉर्मल प्रॉफिट. अब नॉर्मल प्रॉफिट दिस इज गोइंग टू बी obtained by the company. Now this amount of abnormal profit, now this is abnormal, this is not going to be transferred to profit and loss account. Because this is of abnormal nature, we open a separate account, share forfeiture account, and this amount which has been received from Sahil, it is transferred to the share forfeiture account. Now how much amount is to be transferred to the share forfeiture account? I have already explained to you, I have logically explained to you how the things happen, and you already know that the amount which has been received from Sahil is going to be transferred to this particular account, and you would already be making out the right answer. So the concept of forfeiture of shares, it says that sometimes the shareholders fail to pay one or more installments. They may fail to pay the allotment money or the call money, and in these circumstances company can forfeit the shares. Whenever the shares are forfeited, all the entries relating to the share forfeited except those relating to securities premium already recorded in the accounting records must be reversed. So it is trying to say all the amounts that have been received from the Sahil, the entry is to be reversed except securities premium. So if securities premium has been received from Sahil, it is not going to be transferred to the share forfeiture account. Everything else is going to be transferred to the share forfeiture account. The balance of shares forfeited account is shown as an addition to the total paid up capital of the company under the head share capital under equity and liability side of the balance sheet till the forfeited shares are reissued. So how the things are going to work? The company has forfeited the shares, and at the time of the preparation of the balance sheet on the equity and liability side, the company is going to show under the share capital that okay, these are the amount for share forfeiture. These are the amount pertaining to the share forfeiture, and once these shares they are reissued, this amount is going to, this entry is going to be removed. This figure is going to be removed. So this is how the things are shown while preparing the balance sheet. So now let's try to understand the accounting part with regard to the forfeiture. So let's try to understand the entire sequence of events as may have happened from the perspective of Sahil. So at the time of application, the company would have received rupees 30 from Sahil. The company would have made this entry, bank account debit to share application rupees 30 into number of shares which the Sahil has rupees 1000. Okay, and then this share application account is going to be transferred to share capital, share application debit to share capital rupees 30. So the first entry would have been made like this. Now then again the company would have called the money at the time of allotment. Now at the time of allotment the entry which is made is share allotment debit to share capital. So the things are reversed at the time of allotment. Okay, the entry is made like this. The entry is made for the amount due at the time of allotment, rupees 30, and then the amount is received, bank debit to share allotment. Again 30 rupees would be received. Okay, now the company makes the first call, share first call debit. It says the money is due rupees 20 to share capital. It transfers the money to share capital. It is sure that all the shareholders they are going to pay the money, and then again this money is received, bank account debit to share capital. Please pardon my handwriting. Okay, I believe you are able to understand it. And then is the share second call. The share second call it was debited. The company was sure that Sahil is going to pay the money, everyone is going to pay the money. And this entry was again passed with rupees 20. Okay, this entry was again passed with rupees 20. Now, the next entry is something which has not been passed because no amount has been received in bank as of now. We have not received a single penny from Mr. Sahil for the share second and the final call, that is rupees 20. So how much amount we received from Sahil? We received rupees 80 from Sahil as of now. 80 rupees have been received on 1000 shares. So 80,000 has been received from Sahil as of now. How much amount is pending? 20 rupees is pending on 1000 shares. So 20,000 amount is something which is pending. Okay, now we learned on the previous slide that the entries which were made, they are to be reversed now. Now the share capital, it was credited. It was credited by how much? Share capital, it was credited by 30 here, 30 here, and 20 here, and 20 here. Share capital was credited by rupees 100. 100 into 1000, that is rupees 1 lakh. So this is something with which we credited the share capital, but this share capital is not something which entirely has been received by the company. Now these shares, they are going to be cancelled. So this 1 lakh rupee has to be cancelled. This is to be reversed. So when we were increasing the share capital, we were crediting it. Now the share capital is decreasing. We are going to debit it. We are going to decrease the share capital by 1 lakh because we are forfeiting, we are cancelling those shares, and we are going to reissue those shares to someone else who is willing to pay the entire amount on the shares. So now the share capital account is going to be debited by 1 lakh. Now when we are debiting something, we also have to credit some things as well. Now whatever amount has been received from Mr. Sahil, we have received 80,000 from Mr. Sahil. So this amount is transferred to a separate account which is called a share forfeiture account. And the share second call, this was not received from Mr. Sahil by the company. So this share second call, it was debited by rupees 20. So effect of this is to be reversed. So by the balance rupees 20, this is to be reversed. So by 20,000, we are going to again credit the share second call account. So this is how the things look like in the form of a journal entry. So share capital account is debited by 1 lakh. Share second and final call, this was debited by 20,000 when the call was due, but now the call has not been received. Now we have to cancel this particular entry, so we are again crediting it, and 80,000 we are transferring to share forfeiture account. This is the amount which has been actually received from the Sahil. So all the amounts which have been received, they are to be transferred to the share forfeiture account except securities premium. This is something which you should remember. So now friends, we can easily answer this particular question. That the share forfeiture account is going to be credited by the amount received from Sahil. Now we can easily answer verbally as well. So we did not receive rupees 20 from Sahil out of the rupees 100. 80 rupees was not received. 1000 shares were there. So 80,000 is going to be transferred to the share forfeiture account. Answer is option number B. So thank you friends, this was our discussion with regard to the accounting for share capital. Again, I have tried to be very simple, very slow with the things. I have tried to explain you the basics, and I believe you were able to get all the points here, get all the important points here. You were able to understand each and everything. And if you were able to understand, please do make positive comments below. And if you have any query, you can also ask in the comment section. So this is it for today. Bye bye, take care, all the best.